Hey everyone, we talk a lot about tax efficient withdrawals in retirement, but what about a tax efficient savings plan? Not just a plan that will lead to tax efficiency in that one isolated year, but a plan that will give you the most efficient taxation from this point through the rest of your life. The question that we all have to answer at some point is, should you sacrifice tax savings today for tax savings tomorrow? So I want to walk through how to analyze this and figure out the best savings bucket that can give you the most efficient ride in taxes. And today, I specifically want to keep this about making the decision between contributing to your 401k on a pre-tax basis or contributing to the Roth portion of the 401k. So before we get there, let's make sure that everyone's on the same page and talk about the basic differences here. A Roth 401k and a pre-tax 401k, the main difference there lies in the tax treatment of contributions and withdrawals. A Roth 401k has tax-free withdrawals in retirement, while a pre-tax 401k offers tax-deductible contributions during your working years. And there's a few other differences as well, such as the required minimum distribution requirements, but the big difference is simply tax saving today versus tax saving tomorrow. So let's look at an example to see how this would work out in comparison. Let's take a married couple. Both are 50 years old, their kids have just left home, and they know it's time to get serious about saving for retirement. Their household income is $125,000, and they can save $30,000 per year. Now, right now, they have $400,000 in a 401k, and the big question they want to answer is, what's the best way to save this $30,000 per year? Should it all go to the pre-tax 401k where they can deduct it, or should it go to the 401k as a Roth election? Now, I should note here that there's a lot of other options that we can use, like should they contribute to the 401k up to the match amount, and then the remainder could go to a taxable account, and there's a plethora of other combinations as well. But I want to keep this simple and straightforward for this video. So I assumed that they would retire when they were 65. They would file for Social Security at their full retirement age, which is 67. And for account withdrawals, I used $6,500 in today's dollars for net monthly income. And I simply inflated that by 2.5% per year. And for investment returns, I just used the JP Morgan forward-looking capital market assumptions. Now, the first thing we want to look at are the account balances. Now, needless to say, if you're saving $30,000, you're saving $30,000. So up to the point of retirement, when you start taking that money out, the balances are going to be identical. But you can see how those balances start to separate when you get older, and that's mostly because of the amount of taxes that's having to come out of the accounts, which brings us to the real difference maker, and that's the tax difference between the two. That's the big driver of this decision. And a lot of people struggle with moving away from pre-tax accounts because it'll drive up their current taxation. And I'm not immune to this. I've had the same conversations in my own household about moving to the Roth and putting all of it in the Roth versus having some of it in the pre-tax, some of it in the Roth, or all of it in the pre-tax. This is not an easy decision because it does come with tax consequences. But again, we have to refocus and not look at a single year in isolation, but look at the results over the long term. So with this, you can see the orange line is the cumulative taxes if you use the Roth 401k. From age 50 to retirement, which we have at 65, that would account for an additional $100,000 in taxes, as opposed to saving that in a pre-tax 401k. And that number would stay fairly constant until your required minimum distributions kicked in at age 75. At that point, you can see a rapid acceleration in the amount of taxes, and by age 80, the two accounts have broken even. And then at age 85, there is now a $100,000 difference in favor of the Roth 401k. And really, looking at that chart says nothing about two important things. First, what if taxes go up? This scenario that we're looking at here assumes that current tax law is going to stay the same, where at the end of 2025, the Trump tax cuts expire, and we'll sell into the future with only moderate increases to taxes from inflation. And then the second thing is, how will these accounts pass to your heirs? In this scenario, which I find very common, by the way, we see that there's going to be a sizable balance left at the end of the plan. A nice way of saying at the end of their life. And with the Roth account, the heirs are still going to have to take distributions, but they're not going to be taxable. And with that pre-tax account, it's going to all be taxable. So if they're already earning a high income, this could explode their taxes. So ultimately, when you're making this decision, you have to frame it by thinking, how will this affect me from the point where I am right now until the end of retirement? And I know it's a big decision. And if you want some help from me and my team, there's a link down in the description where you can get in touch with us. Thanks for watching.